Welcome to this explainer. Look, if you're a focused learner looking to level up your market analysis, you are in exactly the right place today. In our previous sessions, we've covered the basics, right? We've talked about reading raw price action, identifying market structure, and recognizing those classic candlestick patterns. But today, we're adding a vital new layer of mathematical insight to those basic price action charts. We're going to explore the absolute essential trading tools and indicators used by Forex professionals all around the world. These are the tools that take the raw, chaotic data of the market and translate it into clear, actionable visual signals. Okay, let's dive straight into this with a massive, and I mean massive, reality check. Indicators do not predict the future. It is so absolutely crucial to internalize this before we go any further. Indicators are not magic crystal balls. They are simply measuring instruments. I want you to think of them kind of like the dashboard gauges in your car. They tell you how fast you're going, how much fuel you've got left, or how hot the engine is running. In trading, they're just helping you measure trends, momentum, volatility, and market strength. When you actually combine these gauges with your raw price action, they'll dramatically improve your confidence and your decision-making. So, here is our roadmap for today's toolkit. We'll be looking at mapping market direction, measuring market momentum, gauging volatility and volume, and finally, we'll wrap up with the golden rule. All right, part 1, mapping market direction with the trend tools. The whole foundation of market mapping really relies on trend lines and channels. Honestly, a trend line is one of the simplest yet most powerful tools in your entire technical analysis arsenal. You just draw it by connecting important swing highs or swing lows on the chart. An upward trend line connects higher lows and acts as dynamic support, while a downward trend line connects lower highs, giving you dynamic resistance. Now here's the fun part. If you draw a second parallel trend line, you create a channel. The lower line is your support, and the upper line is your resistance. Price will often just bounce back and forth within these exact boundaries until a breakout finally happens. It beautifully maps out potential buying and selling zones for you while that trend remains intact. And this actually perfectly illustrates our next concept. Because, let's be real, markets rarely move in a perfectly straight line, do they? After a really strong push, price almost always pulls back to take a breather before continuing. Well, the Fibonacci Retracement tool helps you estimate exactly where these pullbacks might logically end. The common retracement levels are 23.6%, 38.2%, 50%, 61.8%, and 78.6%. These are specific mathematical zones traders are watching incredibly closely. But the smartest way to use these percentages? Look for them to align with existing support, resistance, or market structure before you even think about entering a trade. To fully round out our directional map, we bring in moving averages and Fibonacci extensions. A moving average basically smooths out all that chaotic day-to-day price fluctuation by calculating the average price over a selected period. Traders are usually using the 20, 50, 100, and 200 period settings. So instead of reacting to every single little blip, this line reveals who is literally in control of the market. If price is consistently riding above the moving average, the bulls are in charge. If it's below, it's bearish. They even act as dynamic support and resistance themselves. Meanwhile, Fibonacci extensions, we're talking about the 127.2%, 161.8%, and 200% levels. They do the exact opposite of retracements. They estimate future price targets. After a pullback finishes, traders will use these extension levels as highly calculated take-profit zones. Moving right along to part 2, measuring market momentum. Let's look at the speed tools. So, these momentum tools tell you how fast the market is moving, and, crucially, when that speed might literally be running out of gas. Let's compare two of the absolute heavyweights in momentum tracking, the Relative Strength Index, or RSI, and the Stochastic Oscillator. Both of these are going to help you identify when a market might be getting overextended. RSI ranges from 0 to 100. A reading above 70 suggests the market is overbought, while dipping below 30 suggests it's oversold. The Stochastic Oscillator works in a kind of similar way, comparing the closing price to the recent trading range, but its key warning levels are 80 for overbought and 20 for oversold. But listen closely to this. Hitting these levels absolutely does not mean the price is going to instantly reverse. There's no automatic trigger here. Instead, treat these as warning signals. They're just telling you that momentum might be weakening, which should prompt you to investigate further and seek real confirmation from your price action. Next up is the MACD. It stands for Moving Average Convergence Divergence. I know, it sounds like some highly classified government project, but its purpose is actually super simple. The MACD helps you identify trend direction, momentum, and potential trend changes all in one single place. Traders look at this tool and they're mainly watching for the MACD lines to cross over one another, and they're looking for changes in the size of the histogram bars. These shifts are just excellent visual cues for gauging whether buying or selling pressure is actually increasing in the market. Now, let's talk about how we actually apply these momentum tools to spot divergence. Divergence is a completely fascinating concept. It happens when the price and your indicator are moving in completely different directions. For example, imagine looking at your chart and seeing the price push up to create a brand new higher high. But when you glance down at your RSI, it's actually created a lower high. So what does this all mean? Well, it suggests that even though the price is technically still rising, the underlying momentum driving that push is actually dying out. And it works the exact same way in a downtrend. Now, divergence doesn't guarantee a reversal is imminent, but it is an incredible early warning sign that the current trend is losing its strength.
All right, heading into part 3, gauging volatility and volume, or what we call market intensity.
First up in this bucket, Bollinger Bands. And no, that's not a 70s rock group. This indicator consists of 3 lines, a middle moving average, an upper band, and a lower band, and they beautifully visualize market volatility. When the market gets chaotic and volatility increases, you will literally see these bands balloon and expand outward. When the market gets quiet and sleepy, the bands contract and squeeze right together. Smart traders pay very, very close attention to when price reaches those outer bands, especially if they have other technical analysis suggesting a reversal or a continuation is highly likely. Now, what's genuinely interesting about the average true range, or ATR, is how it functions compared to basically everything else we've looked at today. ATR completely ignores whether the market is bullish or bearish. It does not care about trend direction whatsoever. It purely measures how much the price typically moves over a given period. A higher ATR simply means the market is moving aggressively. A lower ATR indicates a quiet market. Why does this matter to us? Because professional traders use this objective measurement of volatility to set highly realistic, mathematically sound stop-loss and take profit levels, rather than just throwing a dart and guessing. Volume is kind of the final piece of the intensity puzzle here. In a lot of financial markets, volume shows you the exact number of shares or contracts traded. Forex is a little bit different. Brokers usually provide what's called tick volume. This measures how often the price changes, rather than an exact transaction count. But hey, don't let that fool you. It is incredibly insightful. When you see a breakout accompanied by increasing volume, it beautifully confirms that there is strong market participation behind that move. Conversely, if price is moving but volume is dropping off, it's a massive hint that momentum is weak and the move might just fail entirely. Which brings us to part 4, the golden rule of indicators, and how to avoid the ultimate beginner trap. Let's take a quick breath and categorize everything we've just learned into a master cheat sheet. This is how you avoid the traps that catch so many amateur traders. We have directional tools like Trendlines, Fibonacci, and moving averages to map out the trends. We have momentum tools like RSI, MACD, and Stochastic to measure market speed. And we have intensity tools like Bollinger Bands, ATR, and volume to gauge volatility and participation. Seeing it categorized like this really proves how structured and accessible a professional trader's toolkit truly is. You don't need to be overwhelmed. You just need to know exactly which bucket you're pulling a tool from. And this leads me to a pretty crucial question you need to ask yourself right now. Are you using tools that actually complement your strategy, or are you just creating chart confusion? A massive, massive mistake beginners make is slapping every single indicator we just talked about onto one single chart. They somehow think more indicators will automatically equal better decisions. But the reality? It just creates visual chaos and conflicting signals that'll freeze you in your tracks. And that brings us to the ultimate golden rule. Keep charts simple. Professional traders rely on really strong price action analysis combined with just a few carefully selected tools from the categories we discussed today. As you prepare to combine these indicators with your own entry rules and risk management to build a truly complete trading plan, I want to leave you with this final thought to ponder. If your indicators are supposed to clarify the market's story, what is the cluttered noise on your current chart actually costing you? Think about it. Thanks so much for joining me for this explainer, and keep learning.